In this week's update, central banks feeling the heat to slow it down. Earnings season more critical than ever. And worst case inflation is priced in. What happens if it doesn't happen? My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Let's start with the market update. It's been another very volatile week. The first part of the week was explosive rebound, and then the last session finished very negatively in America. So let's just step back and just have a bit of a reassessment of what's happened. So the bear market that started in December, January of this year was essentially caused by the fears about a huge battle by central banks around inflation. So everybody knows that. And then, of course, one of the consequences of that battle of pushing interest rates up quickly and perhaps a fair way would be that it could bring on a global recession. And opinions have just gone backwards and forwards all year about the extent of that. Just recently, however, the central banks, particularly the Fed, have made a massive shift, or have made it apparent that there is a massive shift in policy compared to the last 2 or 3 decades. In previous years, the Fed has talked tough and then gone to water, and their primary concern always appeared to be holding up asset values, keeping stock values high, keeping property values high, all those sort of things. So they were very preoccupied with the wealth effect of asset prices. And that's easy to do when inflation is, relatively benign. You can afford to play that game. But once inflation really took hold, and it took a lot longer than anybody expected, there was a lot of expectation in 2012, 2013, after the massive stimulus out of the GFC, that inflation would have to take off. And year after year after year, inflation did not take off. But finally, that's happened because of particular factors, added to because of the invasion of Ukraine. But look, that's not the primary cause. Inflation was baked in and was starting to happen anyway. Certainly, the COVID pandemic played a part in disrupting supply chains. So there's a number of factors here. But the bottom line is that the central banks made it very clear very recently, just in the last month or two, that taming inflation by raising interest rates was their absolute priority. And if that meant that asset prices got chopped, if that meant that they would push economies into a global recession, then so be it. And we haven't heard that sort of language from the Fed since the 1980s, when Paul Volcker was forced to do it. So that is what caused the bear market. Now, we've had several rallies. They've all been spectacular, as they always tend to be in a bear market. And I got a question the other day about why bear market rallies are so severe. And the reason is that there's a lot of large investors who are short the market. And so we go from a situation where, everyone's pretty much selling and people are shorting, to when the market starts to turn around and starts to rally, the only way that the shorters can get their profit is that they have to become buyers. They have to buy back their position. And so all of a sudden everyone stops being a seller and becomes a buyer. And the shorters don't have a choice. They have to buy. Whereas just a normal long-only investor, he doesn't have to buy. He can sit back and just watch. But the shorters don't have that luxury. They have to buy. And so we end up with very few sellers and a lot of buyers. And that's why the rallies in bear markets are so spectacular. Let's look at the inflation status at the moment. Again, this is one that's very much up for debate, and it depends a bit on, how you view the glass, half full or half empty. But many of the inflation drivers are actually weakening. Whether the bears like that and their minds are open and prepared to accept it, that is the fact. Many drivers are weakening. Commodity prices have come down. Shipping costs have certainly come down very, very significantly. Energy costs are lower now than the extremes. And also the fear of a wage breakout is subsiding. There is clear and unequivocal data that says that the fear of wage spirals is less. That's not to say that wages aren't going to stop going up, but the real fear was a massive wage breakout. So many of those drivers are weakening. And what is also becoming apparent is that there's some actual deflationary forces. It's not all inflation. There are some deflationary forces. And just one of those, as an example, is that a lot of supply chains are now significantly overstocked because companies have had to, hold a lot more stock because of the supply chain interruptions. So a lot of supply chains are overstocked into what will almost certainly be a consumer downturn that has really already started, which means that there's less demand. There is going to have to be price cutting by some manufacturers and sellers, and that's going to have a bit of a deflationary effect. So it's no longer wise to be a total inflationary bear. Now, in making that statement, I'm not making any judgment about what inflation does, but I just don't think you want to be totally on that side of the boat, because there is enough evidence that we are either at or close to peak inflation. And as soon as the equity market gets a sense that that is the case, then, and central banks can then relax the rate rises, then this market is going to take off. And so if you're locked into that thought that we're in an inflationary environment and markets are going down, then you might be way too late in acting. So really important to keep an open mind here. Don't get yourself locked into a certain way of thinking. Now, markets have priced in worst case inflation and significant rate rises from here, because that's what markets do. They look forward and they're pricing 6 to 9 months ahead. So there's almost no question that a worst case scenario inflation and further interest rate rises are what's in prices. So what happens if rate rises end up being smaller or slower, or central banks start taking a pause? I mean, the RBA was expected last week to raise rates by 0.5. They only raised by 0.25. So they're slowing down a little bit just to have a look over the shoulder and see what inflation is doing. And lo and behold, the ASX 200 surged 3.5%. So if other central banks start doing that, then we're going to have a very, very strong rally and almost certainly the end of the bear market. However, that's not a done deal. On the other side, what isn't probably priced into the market is if there was a significant slowdown in US earnings season, which starts next week. That is probably not priced in. And one of the main things that could drag earnings down is the fact of the strong US dollar on corporate earnings. So many companies in the States obviously earn earnings globally, and when they translate those earnings back into US dollars, it gives a lesser contribution to the bottom line. So that could be one of the concerns for the market, that the US, it's not that the companies are actually selling less or doing worse, it's just that the currency effect does impact the bottom line. So that'll be one to watch as earnings season starts up next week. But overall, the biggest risk remains central bank policy. If they decide that they're going to just keep the pedal to the floor until inflation starts to back off significantly, then they're going to overshoot and they're going to drive economies into a recession. Because interest rate rises take a while. They take 3 to 6 months before you start seeing it in a slowdown in growth and a slowdown in inflation. So if you keep your foot down hard until inflation actually gets tamed, then you've gone way too far. And so that's the biggest risk, is central bank policy. And that's why the markets are reacting so significantly to every utterance that the central banks are making. So how do we deal, as investors, how do we deal with all these uncertainties? You know, you can. It's easy to become a deer and stuck in the headlights here. But for me, it's just so crystal clear and obvious. It's just business as usual. You own quality stocks. You don't own rubbish. You want stocks that have got pricing power, high return on equities, modest debt, unstoppable growth because they're in a mega trend. And there's plenty of stocks that tick all those boxes. And I've been talking about this for years. You know, but particularly in an rising inflation environment, you want stocks that have got unstoppable growth and pricing power and modest debt as well. So, you know, that's the formula if you want to deal with these uncertainties. So just position yourself to get through this period of uncertainty where we don't know what central banks are going to do. We don't know how quickly inflation is going to respond to these higher rates. And we don't know how the market is going to respond to point A and point B. So it is uncertain. So just control what we can control. Have a higher level of cash. Maybe do some hedging. And your portfolio composition is obviously important. And as we'll see at the moment, there are places to be, sectors to be, and sectors where you don't want to be. And and it's pretty obvious. So you just need to stage your entries and manage your holdings according to a clear plan. If you don't have a clear plan written down that you consult regularly, then I suggest you're in a lot of trouble because you'll just get caught making emotional decisions. So that's the best advice that I can give anyone who's watching this video. Avoid companies that have got high debt or trade on a high PE because those PEs are still coming down, or stocks that have got low growth because high growth in a mega trend papers over a lot of short-term potholes. So they're the sort of companies that you want to avoid. All right, American stocks. The US, the S&P, sorry, it actually went up 1.5% for the week. Sorry, that was just an incorrect wording. But certainly a lot of gloss got taken off at the end of the week. Now, this was a rebound from dramatically oversold, as we'll see, and it was thanks to two events. Firstly, the UK government backed off on the tax cuts, which was really puncturing the bond market, and that was affecting everything, currencies, equities, the whole thing. So that was the first one. And the second one is that a couple of UN agencies are starting to put pressure on the central banks by making very concerted statements that you don't normally hear from that quarter about the fact that central banks were at risk of going way too far. So the pressure is getting ramped up on central banks, that's for sure. So that's why we got the rebound. And then overnight, on Friday night, all the fears came back again because the payroll data was sufficient to allow the Fed to continue with their higher rate policy, and their rhetoric hasn't really changed yet. So the markets are still hostage to the short-term news. No matter what the Fed says or what the data says, that's what the market is reacting to short-term. But don't forget that there is plenty of evidence that inflation is peaking or is close to peaking. So don't lose sight of that. The US dollar index was up again almost to 113, got down to about 110. The 10-year yield was up at 4, dropped to 3.6 with the UK announcement, but then with the payroll data shot back up to 3.9 on Friday night. The VIX, pretty volatile, finished at 31.4, and the 10-2 spread on bond yields is still sitting around the minus 0.4 mark. Let's take a look at some charts. And we'll start with, so looking at the US sectors, because they really set the tone for the rest of the world. And the things to watch are the red line, the 200-day moving average. You want that pointing up, preferably at least 45 degrees, and you want the price of the index to be above it and the shorter term moving averages to be above it as well. That's the ideal, and the energy sector certainly delivers that in spades. This is the finance sector. Looks very different. Everything's rolled over, so not much doubt about that one. This is technology in a very similar position to finance. This is consumer staples. Now, consumer staples has just rolled over on the longer term averages, but consumer staples has fallen apart quite dramatically. And I fail to have an explanation for that one. This is consumer discretionary. It's been in downtrend for a bit longer than staples, but hasn't rolled over with the same degree of enthusiasm that staples has. Healthcare also has rolled over. So there's not a lot of sectors in the US that are actually trading positively. This is what a chart should look like. This is ExxonMobil, the world's biggest energy stock. This is what a chart should look like. It looks very similar to the XLE, of course, which is what you'd expect. And look at what happened to ExxonMobil in the last couple of days when the index was down significantly and on pretty good volumes as well. So, energy is a place to be. This is LNG, so it's not renewable energy, but it's not oil either. But certainly this is benefiting, and these aren't recommendations. This is just showing you these are the sort of charts you want to look for. Rather than start with the fundamentals, some stock that you like, I would, much prefer to start with a really powerful trend and then go and do your fundamental assessment to see if it ticks enough boxes. That to me is the better approach. And in Australia, if you're interested in battery materials, which everybody should be, because that's the mega trend, then here's just one of many examples. So this is the sort of chart pattern that you want to look at. This is on a weekly chart. Okay, let's take a look at the S&P. So strong rally Monday, Tuesday, Wednesday. Cooled off a little bit on Thursday as a sort of a bit of a precaution. It had just got to the 20-day moving average, and then the payroll data came through on Friday night, and that just tanked the market totally. The indices down 2.5%, 3.5%. So right at the moment, looking at that chart, we're clearly in downtrend. The 20 days pointing down very sharply. The price can't get through it. We're still in the bear market. Not much else you can say about that. This is the Nasdaq, slightly better than the S&P, but not a whole lot. And I would expect that we're probably going to see that one break down shortly as well. And when we go to small caps, the Russell, they all look pretty much the same. Let's go to the spread charts to get a sense of where the intermarket money flows are going. And look, it's a bad week for the Nasdaq versus the S&P. We're still above the June lows in terms of the ratio between the two, but it's certainly back down into downtrend again. This is consumer discretionary versus staples. So it's pretty much line ball really, even though Tesla, which is in consumer discretionary, fell very heavily on production data. The consumer staples are getting plenty of selling pressure as well, so not much there. This is semiconductors versus the S&P, still pointing down. I'm desperate to see that turn up, and at the moment all you can say is we've got lower highs and lower lows. Small cap growth versus small cap value, slight turn down on Friday night, but not looking too bad as far as the small cap side of things go. This is large cap growth versus value. We're starting to point down again, so not terribly good looking chart. And this is 1,000 growth versus 1,000 value, looking similar. And finally, but perhaps a little bit of sunshine here, and that's mid-cap growth versus the S&P. So that one's not looking too bad at all. So growth versus the S&P is looking okay. All right, let's take a quick look at the currency. So big dip during the early part of the week, and then quite a strong turnaround into the latter part of the week, and that really punctured the Australian dollar. We finished at 62.99, and I wrote last week that we were heading for just under 60, and that's that is still very much in play. So if you're planning a overseas holiday to America, it's going to cost you a great deal more money. All right, so just to summarise, 62.99 on our dollar. Our index was up 4.5% across the week, which was the best gain in 2 years, despite the fact that there was a sharp sell-off on Friday. And the standouts in the Australian market, energy and lithium, it's not a whole lot different to the American market. Precious metals, gold up $33 to $16.95, actually got up to about $17.20. But when you translate that into, so we had a rising gold price and a falling Australian dollar, so we're almost at $2,700. We've added nearly $200 in AUD to the gold price. So Australian gold stocks should be getting better supported than they have been, but the markets just doesn't seem to be terribly interested. Precious metal stocks, when you look at GDXJ, that stock index remains in a 7-year base when we look at the GDX compared to the gold price. And so gold stocks are almost at historical value lows. That's the good news. The bad news is they've been there for 7 years, and it's not really getting back to where it used to be and where it should be. So let's take a look at gold and GDXJ. All right, there's the gold price, really solid for 5 days or so, 5 or 6 days, and then came off a bit towards the end. If we look on a weekly, it's more obvious. So we broke that 1680 vital support. We've rallied back to it, but then given back some of the gains. If we look at GDXJ, you can see that it was really only on Friday night that gold stocks came down, even though gold had come down on the Wednesday and the Thursday a little bit. The gold stocks actually went up. So a few green shoots here, but look, it's a sector that I just don't trust at the moment, and I haven't trusted it for quite a long period of time. So that's the reality of the gold market. The only way to play the gold market, to my mind, is you want to focus on reasonably advanced, high-class development stocks that have got a world-class resource that's going to get developed, and it doesn't. The price of that, as development progresses, the share price will trend higher. It doesn't need the gold price to go up for you to gain some advantage. So that is where the focus would be for me in the sector. Turning to other commodities, copper was steady at 345. Nickel, which had taken quite a hit the week before, rebounded to 1024, and copper inventories, as we'll see, still edging up. Crude oil spiked up to 93 from the low 80s. It was a decision by OPEC Plus to cut production that really fed into that. There's the copper chart and copper inventory. So we saw some further rise in inventory. But nickel, bit of a bounce back, but no change in the inventory levels with nickel. So wrapping things up, I think investors, this is a really tricky period at the moment, and investors need to buy some time. That should say buy some time to assess. And the way that you can do that is you position accordingly, as I said earlier. It's a combination of cash, hedging and portfolio composition so that you can dampen down the fluctuation in your portfolio so that you can catch your breath, let the market do its thing and then move on from there. Don't feel that you are being pushed into making decisions when you don't, when the timing's not right. It's difficult to make effective decisions when markets are so volatile. So put yourself in a position where you can just kick back a bit and watch and wait. But don't nod off, because the opportunities are going to be extreme. They always are coming out of these sort of periods. And that'll happen again. Our portfolio analyst last week was actually taking stock of September, which is something I do once a month. It's an opportunity to develop skills, to learn lessons about decisions that we made and incorporate those into our trading and investing in the future. Anyone that hasn't taken the trial, is a $1 trial for 2 weeks with Portfolio Analyst, is very welcome to go and check it out. That's it for this week. There's more information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.